good afternoon, everybody. Thank you very much for turning up on time. It's much appreciated. Before we make a start, I always try and do this with sessions of this nature. It's always good to know who's in the room, okay? So if you were happy to reveal yourselves. Operators, hands up. Okay. Just operators, operators and investors, or just operators? Okay. Owners. So we have a few owners. Advisors. Okay. So a good mix, a sensible mix. Right. You will have seen the topic of this afternoon. I did not choose the word stratospheric. But it's a good word to get people interested. What I won't do is I won't make introductions of the panel. You can read about them in the material, and they will have ample chance to explain to you who they are and what they do during the course of the next hour. It's quite a big subject, and so I think in order to make it interesting for everybody, what we try and do is narrow it down a bit and focus on some key aspects of what's in the title. And the suggestion is we need to deal with this concept of hospitality alternative, okay? And what's that? We need to talk about a comment that was made in the subtitle about brand saturation. I think we need to explore that. And quite importantly, we need to talk about investment, which is another word that crops up in the title, because in the end, we're more or less all in the same game, which is trying to extract as much value as we can from these real estate assets, wherever they happen to be and whatever type they happen to be. So this is something that I'm quite interested to hear from the people on the panel about how they view that, getting the value out. You know? Highest and best use, all that good stuff. That's what it's all about. So I would like to start by asking anybody in the audience whether or not at this stage anybody has a question that you would like us to deal with, because we have plenty to talk about. We could talk for the next 3 days about this, but this is to a certain extent meant to be a participatory event, so if you have any questions then please let me know. Okay, well then we'll make a start. And I would like to address each member of the panel to I think start off by explaining. I think it's important in this session that they explain what it is they do and how they see themselves as being alternative or not. Because somebody has put them in a box that says alternative, okay? And I'd like to know how they respond to that. And how they, so I'll start with Sean. Do you like being alternative? Do you wear sandals with socks?
Well, based on the rugby scores between England and Ireland, we are far from alternative. So for those of you that are rugby fans, we're a global hospitality company that specialises in service departments and apart hotels. I don't think that's at all alternative, considering the title. Hospitality is in the name of the conference and its investment. So I don't really see that. I see it's in the debt stack, it's in the risk stack, and it's just part of a selection process. Mixed use, offices, and our system and our model is a distribution system as well as an asset system. So that's common with hotels. Marriott does the same thing. They connect with thousands of customers, they put it into their system and they disperse it to their franchisees. We do exactly the same thing. How that's alternative, don't have a clue.
Okay, so you're mainstream.
In my view,
you're mainstream. Okay. And what about this issue of branding? And so, how do you see that?
I think one of the topics was talk about brand saturation. So I think what's fundamentally changed is what we've all seen is this dramatic influx of capital, high net worth, pension funds releasing in a different manner, flight to safety for capital, hence demand in all sorts of asset classes. Hence, we've seen certainly the hospitality hotel brands pushing out multiple other brand segments and tiers. That is to deal with how do you slot in another brand into another square mile or kilometer, because their core brands are saturated. And hence, I think our time in these types of choices is really now because investors are looking for yield. We have extraordinarily good covenants. a long history, nearly 20 years in the marketplace, so it's a natural place to look at office, look at our stack, look at a hotel. Do you demolish the building and make it a parking garage? So it's because of that saturation of hundreds of brands trying to put their flag on the outside of the building, they're looking for sliver space just to accommodate that. So I think we're an outstanding, all of us in some form or other, are an outstanding part of that selection process.
So from your point of view, how many segments of the market do you talk to with your business?
So we were the first in our space to segment pricing, taking something very complicated, alternative, possibly 3 years ago, and making that understood. A, converting to a hospitality company. B, putting in 6 brands that are conventionally known from 5-star to 3-star, and then pricing it and yielding it and putting it in a conversation that the customer can understand, that we are now seeing customers self-select. Those of you that saw the conversation last night as the closing session, hopefully somebody caught it, with Airbnb and Graham Covington and Leo Johnson speaking to about how does a brand bring itself alive in an ecosystem that's dense. So in our model, it's encouraging consumers to engage with great restaurants in the area, making that micro ecosystem part of the offering versus us trying to run a F&B operation. Why bother? There's people that can do it much better than us. It's not a good use of our capital, and we don't think it's a good use of our investors' capital. So that, in essence, boils it down to alternatives, debt stack, and essentially brand stack.
Okay, then if I just move to Anton from a branding point of view, because you've got multiple product types and positioning, but you have Viceroy, okay, but you still have to deal with the same issues of segmentation and giving the customer what he wants. So what's your approach to achieving that?
Our approach to segmentation is a bit less and a bit more complex than at the initial investment stage, because we come in once the decision to build a hotel has been made, once the decision to build X square meters of a hotel has been made, and once the decision to build a luxury hotel has been made. So we come in, and a lot of these alternatives have been chosen or have been checked from. We engage in the discussion of what will it, in that funnel, in that narrowed sphere, what it is that the customer will want. And we recognize that whatever decision we make today, we're going to have to live with and operate and optimize for the next 30, 40 years, depending how long our agreements are for. And as we discussed before, once you built a 36 square meter room, if you realize your customers want 45, 10 years down the road, you're not going to push the walls out. You're stuck with the room the way you've done it. So taking a punt on the market. Yeah. We also appreciate that customer trends do take some time to modify, and at the end of the day, there's always going to be enough people that will want the product that we're building today. We have a huge amount of customization opportunity in the product that we offer. And that's from yielding, that's from the additional services we add or strip from the rooms. So we spoke about deconstructing prices, and we've had a long debate about deconstructing our rates, and we viewed it, we're polarized about it, but we viewed it still as going down market compared to a guest that wants a luxury. So we chose not to do that, but chose to add to our product to charge premiums. We still feel that there's enough customer out there that wants the premium service, wants a luxury, and is willing to pay for more. Prime example we're discussing as well is, do we build a lot of suites and at the risk of having to upgrade a lot of people in there? Well, let's build suites and let's price them reasonably, because people are willing to pay for them, but they don't want to feel ripped off paying for them. So instead of having 3 multiples, make it 1.5 multiples of the price, and people will stay in them. So our flexibility and our ability to customize our product comes from the services we add. Whether you add freebies, you charge a premium, you take away breakfast, you take away F&B, all these items that are available that are not built into the building as such. Because once the building is set, it's set, and we have to.
So there's a theme here which is to do with flexibility. Yeah, it's the ability to adapt your product to your consumer.
And that is one of the
needs are going to change regularly, whereas in fact your building is tough to change regularly.
Needs, price points. We operate in seasonal destinations where, in summertime, it might be a low season. You will have to drop your rates, or an airline would not drop their rates. They might choose to fly a different aircraft with more compressed seats because it's cheaper and more economical. We don't have that flexibility. So yes, in preserving what is a solid product, we up or down the ante. Our volume lever is a bit narrower than at the investment phase by adding or stripping services.
So you don't see yourselves as being alternative either?
I see us as very alternative.
There's another theme
in that narrow bandwidth, we are alternative, and we dare say yes when we say yes.
So it's a point of differentiation for you?
It is, and where we get involved in the economic modeling ahead of the building being built, we are engaging collaborative with our developers to look at alternative ways of funding it. The Advisory Dubai on Palm Jumeirah is the first full condo hotel to be open in Dubai. And nobody's done that. No operator ever got comfortable with that. But it was an alternative way of funding a property fully with 477 keys. So it's a significant undertaking, and we've gone ahead and did it and done it. And we are experimental within the boundaries of allowing us to offer something that is true and honest to what Viceroy stands for.
Okay. So Max, from your point of view, because you're at a point in time with your business, with not a launch phase, but a consolidation phase now, what was your thought process behind setting out to do what you're doing? Was it to be alternative, or was it simply to run a profitable business and within the mainstream?
I think I'd like to challenge the word alternative. I mean, I don't think operators setting out to be alternative. I think the customer is driving demanding a change in experiences. So I think when you say alternative, I think what we're really talking about is, are we adapting to recognise the needs of the customer and experiences that he's looking for? And I think if you take a typical customer over a 12-month period, he's likely to engage in several experiences / alternatives. And I think you'll find that a weekend for me away with my wife is likely to be at a different experience than it is if I take my children to banger car racing for the weekend. I'll choose a different brand and a different experience. So I think everyone's is an alternative. I think particularly what we've been doing with Oaktree Capital Management over the last couple of years is on the back of an opportunity identified in the marketplace to meet a experience requirement / alternative, which is the apart hotel sector. We've managed to put together a sizable portfolio now, and with the announcement on Monday morning of Oaktree's acquisition of Seiko, that now gives us a launch pad to take that Seiko business and a group level have Seiko managing multiple alternatives / experiences. So beyond apart hotels will be a vertical, Seiko service apartments will be a vertical, and we will expand that suite of experiences / alternatives on the back of what the consumer is looking to experience.
I'm interested by the idea of experiences. It's potentially an overused word, isn't it, experiences? From your point of view, how do you define different experiences? Is it easy to have clear lines between them so that you can say this is definitely for this customer because of the experience? Is it truly driven by that?
I think it's driven that there's a price point. There's a amenity requirement with that stay that you're having. There's a location requirement. And these all blend in. If you wanted to blend it into Matrix, it gets very complicated. But yeah, I think it's relatively simple, but it is complicated. The underlying requirements need to all be understood. But as I said, if I'm in London for 3 or 4 nights on a stay, I want a different experience at a business level to if I'm in Cardiff one night and I'm going there for a meeting and I'm having dinner and I'm leaving at 7 in the morning. I don't need to invest in the experience that I would do in London if I was there for 3 or 4 nights. And I think the consumer is very smart now, and as brands become more clear and defined in what their offering is, it makes that choice a lot easier for the consumer.
So there's this theme of flexibility that's come up in terms of being able to give people offer them what they want. Okay? Not necessarily what they need, but what they want. So this is about dealing with customer wants. So Navneet, from your point of view, my understanding is that this has been a significant part of your business model with this focus on flexibility because you've got multiple product offerings within one asset, yes?
Yes, I agree. Ours is a very flexible model. But just coming back to your original thing about alternatives, in some ways, in my experience, when I looked at mining and came into the company, and it's been around for 15 years, but the company I work for, Cox & Kings, the group, they bought it about 3 years ago. And we bought out the original partners. But what I realized is it's a unique model. I mean, nothing like mining exists in the world, in the hotel world. And therefore it's you can call it alternative or whatever, it's unique. The reason it's unique is, and that is because it's flexible, is because it combines uniquely a hotel and a hostel experience in one building. So it's both a hostel and a hotel, if you like. But essentially it's a hotel with multi-bedded rooms. And they used to have family rooms in the past, something like that. But it's a good quality designer budget hotel with a flexible accommodation, which means it has regular double beds with pull-out sofa beds. It also has multiple beds in it, up to 4 or 6 beds with bunk beds. So we can accommodate a variety of customers from a customer point of view. So we have school groups who can be accommodated. We have families who can be accommodated in one room. A family of 5 can stay in one of our rooms. And we have the celebration market, so-called celebration market. That means backpackers, people on gap years, they can book a bed and share it with somebody they don't know, which is a traditional hotel product, hostel product. We have so-called flashpackers, as they call now, people who are actually more upmarket than backpackers, but they still want to share with people. Part of the sharing economy, they want to have a sharing experience. They want to share with people they don't know, right? So they can meet people for that kind of experience. And that could include, and also people who are on for example, if they're on a stag night or a hen party, or they're going to a certain gig or a football event or to watch rugby, they can go in a group, so sport groups. So we accommodate these groups, family groups, school groups, these celebration groups, but we also have individual families staying with us, but also individual businessmen. So we create the product, depending on the market, the location, the particular location, which is, if you like, more of one, getting to one kind of customer than the other. And the product is flexible, so that the market demand changes to some extent. And it can change during the week, weekends, we can accommodate them all. As a result, Meininger's he's got 16 hotels right now, 4 in Berlin as it happens, because the Berlin's the headquarter, 9 in Germany, 4 in Austria, 1 now in Brussels, in Amsterdam, and now in London. And our average occupancy last 3 years, right through the downturn, because of this catering to so many different demand generators, and we measure bed occupancy. Everything is focused on the bed, because it's the bed that we're trying to sell, if you like, is around 79% last 3 years, and right through the recession slowdown, which equates to around 90-95% room occupancy. So high occupancy product, which is and flexibility, because you can, when we go into a building, we can convert it to a Meininger quite easily, if it's office building or a bank building, because the nature of the product is not prescriptive, like a traditional hotel product. So in that sense, I'm answering it in a very roundabout way. It's very flexible, because it caters to these different market types. But you've got to decide up front, when you obviously go from an investor's point of view, what you're building, because you can't change it later physically, except that this product is able to generate, you can accommodate a family group of 5 in it. You could have a school group using all 6 beds, or a room with a double bed and a bunk bed. You could have a businessman staying there, and he'll feel still is fine, because that day, didn't have demand for 4 beds. So the product is adaptable.
I'm guessing then that it's quite profitable.
It makes more EBITDA per square meter than any other hotel product I've seen in 30 years.
Okay, so what do you see?
From an investor point of view, it's very high return.
So what do you see as the barriers to entry? Surely everybody should be doing this.
I think it's the operating model. This business has been around for 15 years. The guys who built it have, how do you tie in 4 to 5 different types of customers, business people, backpackers, family groups, school groups, into one building? And it's still it's a limited service, but it's a pretty high quality in terms of, it's like a designer budget. So it'll equate to Ibis Styles or a Holiday Inn Express in terms of quality. So the question is, what's the barrier to entry? I think it's knowledge of this marketplace and how to operate it. And the guys who started it off, we're lucky to have bought them at the right time, at the right price, and now we want to expand it and grow it.
So you're part of it, this, going back to the stratospheric word, I mean, you see that this is something that will simply continue to grow as you place it around, presumably Europe for the time being.
Yeah, I think there's an
unsatisfied
unsatisfied
demand is there.
There's a demand. I'll give you an example, just anecdotally. We opened in Brussels 2 years ago. It's an old brewery. Just to give an example of flexibility, it's a brewery converted to a hotel. So it's very wide corridors. You can play football on them sometimes. I've seen kids playing. It's wide corridors. But the point I'm making is it's a brewery, so it's flexible in terms of conversion. It's not Brussels, if you know the market, is not a traditional school group market. It's not where school groups traditionally went. We built it, we put it up. First month, 80% occupancy. We were getting all the guys from the existing hostels, which are very poor, mom and pop, fragmented market, moving to us. And it was, we entered the market very successfully. And then suddenly we had the school groups who came to see us, who've been going to other hotels, starting putting school groups there. And using that to go to Bruges, to other places in the Netherlands or in Belgium, and making tours around that area. Starting getting that. One day, Eric, our CEO, was here. He'll tell you the story. We had people with banners inside. They were from the Palestine, actually. They've come to protest at the European Commission, and they were looking for an accommodation. They were willing to share. They were protesters. Right, and so in a way they're business people. They're coming on a business trip to make a point at the European Commission, but they were sharing rooms and they were staying in a hotel. Of course, they had their Palestinian flags as well there, but we had a high occupancy that day. So it really does have a niche where sometimes you don't know where this new demand is coming from.
Going back to your point about deciding what room to build, we're finding increasingly that choice for us is being diminished by the value per square foot in pounds or euros. So there comes a point in the sector that we're in, service apartments and apart hotels. Typically that is driven by a business traveller being, if in London, the CBDs and some of the regional opportunity areas, we've been driven by pound per square foot or euro per square foot. So we haven't always got the choice. We haven't got to be clever with the room. And I think as that gap keeps on widening and the competition with commercial and residential, the smart operators will change the amenity experience, so the way in which you deal with the guests as opposed to what... I think the room has to always be smart, but there comes a point where it can only compress so much, and we've got down to 12 and 14 square metre rooms that are still operating very, very well. And it's not because of the size of the room they're operating well, it's the whole experience. So it's the whole engagement from booking through to departure, the amenity space within the building. It's not necessarily as focused as it has traditionally been in the room. So, I mean, we on some of the units that we're developing, we simply have to get a unit count in to make the site work. Because we're competing against other investment classes which are showing returns at a level that means we've got to compress our room.
So what, of course, we've done is we've compressed the room, but we've also taken air, because we have bunk beds.
Well, you brought in air rights. The ability to go up rather than out.
But the thing is that, with a 10-meter height of room, typically, we can get a double bed very easily with under regulations. So you don't have to have a higher room than a typical hotel. But within the same height of a standard hotel, you can accommodate a good-sized bunk bed within the regulations. And different cities have different regulations for the height of the... But we are able to fit it in.
That's an experience choice, isn't it? If you're going to book a brand that's got bunk beds or fold-away beds, again, that's a choice, isn't it? And it's another fragmentation of the hospitality market, another segment.
Right.
Which,
But when you look at the customers and you look at generators as an example, they're actually making more on their beer than they are on the room.
Right.
So, I mean, we just published our business travel insights, and we've taken 20 years of data and annually about 30 to 40,000 customers, and we've started publishing this. So if you leave your business card, we'll send you the publication. But to the point of choice, I mean, we found that nearly 47% of the travelers are making their own decisions. Just some quick stats. for reference point, 64% of them use OTAs within their travel policy. 73% of them, naturally were slightly biased, said they like service departments, so I wouldn't believe that stat. But more importantly, the window to purchase, 44% are saying we'll use it for 1 to 4 nights in less than 2 weeks. So there is a wide berth that, even though our length of stays are running 75 days, we're seeing the window for purchase and choice being 2 weeks. So I think it's going to drive a very fundamental change in most of what we do as to how you yield manage. And from a data perspective, you know, we've really focused on what the customer is telling us in these short-term patterns, because we lose margin by being overstaffed for something that is actually changing our fundamental metric, which is I clean every week or every 2 weeks. Now we're looking at 1 to 4 day stays, and they're looking at this as an alternative, if you will, to at least keep the term alive in here, as will I use a professional experience such as a service department, or am I going to stay in a hotel? Both are equal, according to 70-odd countries and multiple nationalities. So data is driving our machine, and in turn talking to investors saying, and I agree with you, Max, it's getting smaller, but it's also getting more short-term. So density, and again, I go back to what Leo Johnson was speaking about yesterday. Someone's going to correct me, right, because I'm constantly making errors with statistics and probably making them up. Is if I understand correctly, Hong Kong has about 110,000 people per square kilometre. London has 11,000. So the question is, which city planner is going to be brave enough to go up, like your model? You should inspire them.
Right.
And who's going to go up and who's going to go out? And so I think density is a big issue, short-term, different models, and it's exponential. What we're seeing from our data is the fundamental change in self-select is moving faster than Moore's Law. I mean, I know our company, what it was 18 months ago is not what it is today, and it certainly won't be the same 18 months from now. So I'd certainly encourage those of you that are collecting data, pull it, look at it, interrogate it, because it's changing rapidly. Much faster than our development.
Questions? Sorry, Sean. Anybody have any questions?
Anybody want to correct my stats? Because I'm wide open to it.
Anton, I was going to ask you, from your point of view, because you, as you said earlier on, you're within the luxury framework. Okay, so that sort of defines you to a certain extent. So how do you perceive what's going on outside there in the service department world as it affects your business at the luxury level? How do you see the difference between people looking for a luxury service level as opposed to a product that could offer the physical characteristics of luxury but may not get the full service hotel treatment?
We definitely look at, if you use Michael Porter's 5 forces, you've got the competitors and you've got the alternatives. And in our view, I look at them as one and the same. It all depends on who the customer is for that stay and what their objective is. If they're looking for a place to sleep that night and a meeting next morning and then head out to the airport, we could be up against an Airbnb apartment down the road because the location is a driver. Budget within the budget, whatever it is, but the location is a driver, ease of access to the driver. If you're looking for more of a leisure destination, let's say beach or a resort, we probably would be looking more at competitors rather than alternatives, because you do, as a guest, you're looking for the service, you're looking for the amenities, you're looking for somebody to serve you breakfast in the room, and so on. But if it's more of a city experience, then your competitors your gamut of competitors is much broader, and you're looking at competitors in the traditional sense, and you're looking at alternatives that are competing with you.
I'd agree with you, because that's exactly it. Nearly 66% of our respondents said, actually the highest stat was the location will drive everything over brand. So the spectrum of choice becomes quite narrow when it's about you and self-selecting, am I going to stay at an airport? If I am, then what's the range of options for that particular experience at that time?
And we're seeing more competitors and alternatives merge into one when we look at our strengths and weaknesses and so on for analyses for locations. It's not competitors as in what other brands do I have on the same strip, but where can my guests stay?
But they're also looking for safety. So 67% are saying, okay, location is important, and then they'll start self-selecting down to the criteria that fits them, risk, meeting space,
And-
etc.
and-
Do you all look at the consumer decision-making process? Because to a certain extent, it seems to me that this whole subject is, as I've said in earlier conversations, to a certain extent, this whole business is to do, it seems to me, in simplistic terms, is segmentation. I've said this before to everybody. It seems to me just about segmentation, understanding the customer, give the customer what he wants. But from all of your points of view, do you put yourselves regularly in the shoes of your customers and really anticipate what they're looking for?
All of our conversations.
Or do you just see that as a result?
Our conversations are with our employees, our brand ambassadors, and with our customers frequently. Because both will tell you what they're hearing. This isn't working for the customer. It's not working for me because it takes too long to check in. And you'll hear from the customer that's saying, like your brand, wrong location. When you love your location, improve your experience inside your product, whether a hotel, be it from your end of it to all of our ends. It's the same conversation that's going on. And the question is, how often do we go and stay at our competitors?
What conversations did you, because you're involved in something new, yeah? We've seen it, understand there. What conversations did you have in order to be able to get to where you got to, so that you could make your statements?
We engaged the services of 3 or 4 analysis companies that went out and talked to the business and leisure consumer. And just to reiterate what Sean said, location absolutely was the top priority. Price point, funnily, came in about 4th or 5th. It wasn't, the people we spoke to, it wasn't particularly the most relevant decision to them. Safety was very, very important. Free Wi-Fi was on there somewhere. The check-in and check-out experience was very important. But I think from my perspective, and certainly from Oak Trees, we've joined forces with Seiko, who've got one of the highest guest satisfaction scores. And that's the real testament, isn't it? It's when your guests are coming back and talking to you about how much they've enjoyed their experience. But to your point, we have to keep on checking. Now, if the levels or the points that are being raised change fundamentally, we don't want to be in a central location. We can't do much about that. So at some point you have to believe in what you believe in as far as towns and cities and locations. And there's opportunities. I mean, at the moment in London, for example, Crossrail, that's an opportunity for all operators to put themselves along that line. But you've got to keep on going back to your consumers, the bookers, because they have a different requirement to the consumers, and making sure that where possible, you're meeting them.
But isn't it schizophrenic, Max, in some respects? Because the developer doesn't necessarily have the same objective as current consumer trends, or they're lagging. I mean, you brought that up.
So do you see yourself as ahead of the curve or behind the curve?
Because we're at the mercy of economic forces, generally we're behind the curve because the developments are ahead of us. So forums like this to try and influence developers and investors to, as much as we've all been trying it for years, is to get us involved earlier, because you'll get good stats similar to what you're doing. Yep. Smaller spaces, more efficient. Granite's good, but you don't need to put in the most expensive fittings to make some designer happy. You're not going to get a return on that. And we've got good, long history, 20 years of history of consumer data and trends that can only benefit you on your resale, on your sell forward in the chain. So we're laggard. We're out of balance with a very fast-moving consumer trend and a very slow development process.
We're only going to go more out of sync with our consumers because it takes anywhere between 18 and 36 months to build a hotel. So from the day you confirm the plan...
So we're the retrofitting.
We are in the
Based on
retrofitting
data, which
business.
is 3 months old anyway.
It's about convincing the guests that what I designed 3 years ago and I'm opening today is really what you want today.
But I think we can compensate aggressively with technology that's readily available, from streaming to media to efficient check-in retrofits. How you check in with a key. Well, it can all be done with an iPhone. That's not expensive to do in the scheme of the build. So we can certainly influence at that last step to actually make it accelerate forward and still accomplish a developer's goal and a bank's goal and everybody else who's got a piece of the debt stack.
Talking about financing, let's just for a moment, if we can look at the condo hotel experience. Okay? That's a very particular model, been tried several times by several people in several parts of the world, not always with massive success. So, I mean, you're obviously quite pleased with what's happened. Is there any fundamental, for example, design issue that you have dealt with or you've discovered as a result of the development that is part of that business model? That means that because it's sold in that way, that it's different, or is it just another product and the deal is a financial one?
It introduces a new level of conflicts at the design stage that we would not have had otherwise. Andrew Humphrey's sitting in the audience as well. He'll tell you how many battles we've had, because it's not only optimizing best use, it's converting every square nanometer of that building into sellable space at the expense of the operation, even at the expense of the operation. That's the battle we constantly had to do, where we need storerooms for extra beds on the floor, and the answer is, well, I could sell that for $500,000. What are you going to do with it? Well, you know, there are some basics that you need to have anyway to be able to generate the other $1 million that you want from the rooms that are already there. So yes, it created a new level of complexity at the design phase and at the conception and programming that we would not have had otherwise. Because with room sizes, you hit the correlation between room size and returns on room size is not linear. It's a step process, whether you go up or down. And you do hit a point of diminishing returns, so where even if the room is bigger, you're not going to get more premiums for it. So it's a bit of an art and a science to find that point, that size of room where you're going to maximize your returns without hitting that ceiling of rate. But then you've got to make sure that you've built all the add-ons on the back that will allow you to provide the service other than the space. Because in addition to providing the experience, the hot air and the comfortable mattress, you've got to man it, you've got to service it, and that requires space behind it. So the condo hotel model, while facilitated a rapid development, while facilitated financing, created a whole level of complexity. And I think we will, because of that, because of some compromises we've made, we're going to start seeing pressure on our margins, pressure on certain areas we're going to have to compensate with by having additional manpower to compensate for the fact that we don't have X spaces on the floors, and we're going to have 2 more buddies, 3 more buddies running up and down the stairs to satisfy a service need that is expected from a room or a product of a certain level. So we had never faced that before.
So is there something about Dubai in particular that made it work, that would make it more difficult in other places? So I'm sure a lot of hotel developers, and I know this for a fact, would love the idea of doing it, at least on paper, because they may not understand the operational consequences of it.
I mean, aside from the financial economics of it, of what you pay for the land, or what price of land you pay and how it's calculated versus what you sell, it took a lot of courage to come up with a model, because the market is in a good place today, to say no tricks, no hidden fees, no fine print. This is your cut. It's 40% of the room revenue. No additional fees, no HOA. I'm not going to trick you, and that's what you walk away from. And I think that was daring, that was gutsy, and the finances worked in that line. We got 20% of the revenues cashed in within the first 3 weeks, and that allowed us to get on with the project. Proof is in the pudding. 80% is due upon handover. But we're at such a point where the property valuation has gone up so much. If 70% of our buyers defaulted on the payments, the property was still paid for, and the owner's saying, I'll take them back, no issues. So it's unique to Dubai, but it also took a lot of courage from the developer to say, here's my model. I'm not going to hide things. I'm not going to charge you every time you call me or every time you ask for housekeeping. That's what you get. End of story.
No, that's encouraging.
Which were the nuances with the condo model elsewhere, in North America especially. You feel ripped off. You buy the place, you buy the asset, you're enjoying it, but then you realize it's merely covering its expenses, not necessarily giving you anything. This will pay off, and a lot of people will see good returns from it.
Now, Anton raised a point earlier on about the law of diminishing returns. And certainly when it comes to the luxury segment, clearly size is a very important issue.
Just hit that.
Yeah. Bigger is better, but there's a limit. There's a limit. I mean, how many people can you fit in a room? There must be a limit to that model.
The acceptability of.
Yeah.
Well, as I said, our model, we have different types of rooms, but the room size varies according to the number of beds. So, on the average, depending on the efficiency of the building, it's about 8 to 10 square meters per bed is what we get in terms of the way we design it. So,
So per single bed?
per single bed. So if it's a 4-bed room, double bed, you could be at 32 square meters, plus the bathroom, etc. So as you know, it's a regular room, except that you're using it more efficiently in terms of number of beds. But just the other point I was just thinking about it was that you talked about yield and investors, and if you like, one of the, and you talk about alternative investments coming in, and you see this trend right now that there's negative yields right now. People are, the world is about QE and negative yields, and so there's a search for yield in the market by investors. And a typical hotel, and talk about an alternate here, is giving investors a yield which is very much loaded at the back end in capital gain terms, right? So what we found, of course, we're looking at customers, and they're changing, but the investors' demands are also changing. And I think investors are trying to get yield as well, as much as they can. And that's what we found, that our model, this particular one, because it generates high occupancy and therefore has a very strong cash yield, if you like, return on investment, it satisfied the needs of pension funds and so on and so forth, who want regular yield. They just don't want capital gain at the end of the day, big IRR, private equity style. So what we did, for example, is we've done a deal with the largest investor in Europe and announced it in December, France de Mio, part of France de Region, which has about 3.5 billion invested in hotels, particularly Accor, $1 billion in Accor, 660 million B&B. And since we're an operator, and they're looking for yield on their costs, effectively, being owned by Generali of Italy, BNP Assurances, they're looking for yield. They don't want just capital gain in the end. They are a REIT, so they don't want to sell. They want yield, and what we are able to give them is a yield. So they announced that they give us 400 million euros to build more mining hotels across Europe, right? And so I don't think they see us as alternatives because it's a hotel product. I mean, it's an institutional product. But they think that we can generate yield for them and for their investors. And therefore, our model is a lease model. So, all the financial side has to suit the investor model as well as the customer. So all three fit in well then. That's how you can make the whole thing work, because we generate a high occupancy, we generate a high listing, we can give a rent. We cover rent 2.3 times with EBITDA, so it's quite a secure covenant. And the investor therefore gets a strong yield. And he's not interested in selling because he's a long-term investor.
Sean, from your investment point of view, is that your experience as well in terms of the attractiveness or otherwise of your business model to investors? Because presumably they're also looking at, dare I say it, the traditional hotel model.
So depending on jurisdiction, if you take Germany as an example, which would be pretty much 100% lease, versus the United States, which has alternative ways of establishing underwrite.
Yeah.
We have a AAA rated covenant, so that certainly helps broaden where we invest. But we're asset light. That's not our model. Very different than Oaktree or your own Naveed. So our value proposition is that we get deals away. So you want a strong covenant to get a deal away in a primary market. We fit perfectly into that mode. Of course, we offer management agreements and everything else, and then plus our distribution. So if you look at if you step one step back, the bank wants, whoever the backer is, whether it's a high net worth, a REIT, or an institutional debt stack, then they want predictability of yield. And they're going to look to best in class, whether it's a hotel, whether it's an office, whether it's condos. to ensure that capital between when they invest to when they depart. So we're like the meat in the sandwich, but they also want yield. So I agree with you that 1.3 on the EBITDA ratio, we fit in there. Our occupancies are running 94% occupancy. It's generally, depending on the market, primary versus secondary, up to 20 points more than a hotel. So the discovery, the enlightening period that we appear to be in about the types of assets that we are purporting has changed the dialogue. So it's broadened banking, it's broadened where people invest, and the jurisdiction. Germany 100% lease, America's got, depending on the zone, has not necessarily in that mode. So that covenant is core to getting deals away. That's where our value prop is.
So what about the traditional hotel chains that create products that are, if you like, in line with what you guys do from a service department point of view? I mean, how?
Yeah, it's interesting.
Is that working for them, or?
Well, I'm a hotelier, so certainly in my previous life, where we create brands that fit, there is a distinct difference in how a general manager of a hotel finds a appropriate guest that stays longer than 15 days. The whole sales team in a hotel is not geared towards that type of customer. And they look the same, they take a same picture, like the great looking people in the audience here, but they behave differently. They come from a different source inside the target, i.e. JP Morgan has a different view of their hotel program than they do of their service department program. So that's why it doesn't fit within that world, is how they're actually going to source a customer under that brand. It's a different customer that stays at Staybridge Suites versus Residence Inn that stays with us. They look the same, but they behave differently. A consultant has a different mandate, 90 days versus 15 days for a project manager. That machine is not geared towards sourcing that, and that's the fundamental difference. It looks the same, might dress the same, but does not behave the same from a source.
So Max, do you have a different machine? Is it noticeably different to get the customer?
Sean's point is very valid. At a corporate level in the service department and part hotel level, the decision maker who's buying isn't the end user. It's coming through a department that is mobilising a team into a city. So the decision process is very, very different. And it's more at that level about the ability to report back and the billing terms, etc. with the corporate. So it's a very, very different decision.
Yeah, I agree with you. It's one is transactional, this is consultative.
Yeah.
Completely different sales force.
And different emotions that make you buy. So very, very different.
Any questions, anybody? We're all ears. No? I was going to ask, just coming back to this point about growth, okay? Because it seems that you're all in phases of growth, okay? Is that fair to say? You must have big expansion plans.
Definitely.
And, take on the world, okay? So what is it that what are the barriers to that growth? What is stopping you? Whether it's to do with the availability of property or whatever. What is stopping the growth right now? And what are you going to do to deal with it?
Availability of assets to acquire consistently becomes a barrier. I think outside of that, because that's been around for a long time and will still continue to be there, you've got tightening planning laws. I think the shared accommodation discussion at the moment, again, it's different by country, by region, but that's bringing an interesting barrier to some properties. And it cost and yield. I mean, it's that's for us. It's not the ability to acquire, it's making sure we're acquiring the right stuff. And making sure that we're in line with the consumer's expectations on price point, because any of us here can make a property on paper in theory work, but it's going to be about the RevPAR and the cost of that RevPAR.
Do you find there's a downward pressure? People are just, over the last few years, I think we're all consumers, we've all become used to the idea of paying less. Do you find that? Is it basically people just saying, I'm sorry, I'm not going to...
I haven't seen that.
You haven't seen it?
No. We've had CAGR growth of 6% compounded for 5 years. I don't think it's about price, it's definitely about value, and from your question about the constriction for growth, is the shifting sands of yield. The good news is we're actually in the conversation today, whereas 3 years ago, this couple of us may not have been in this conversation about what's best use for that asset. So in some respects, we actually have more growth opportunities than we had before, because we're actually in the game. You have predictability. It's a good thing that there's consolidation in our space. It's a good thing that another brand has come to the table. We started that 3 years ago, and it's good to see that. The more there are, the better, because again, it makes it a predictable investment. And investors want predictability, and our consumers want experiences. They're kind of on both ends. I want unpredictable but safe as a consumer, but high predictability as an investor. And we're straddling both of that. So I think we're actually seeing growth because we're at the table with a predictable product. And that's exciting.
I think to your point again, Sean, there, I think particularly in the apartment sector, that 2 years ago, Oak Tree Capital announced they're going to put $500 million into the sector, which it's fine, it's private equity, and their investment is to make money in assets. But I think with the news, and I am promoting us myself, obviously, but
come on, get out of here.
I think to Oak Tree to come back into the market again in this sector and support an operator, it's clearly an investment they're very comfortable with. And they're looking to deploy more equity. So we get very comfortable with that. And I think for alternative experience, choice, whatever you want to call it, it's about institutionalising the new alternative/choice.
Max, you're right. A year ago today, we transacted with a private equity company. It was the first financial transaction in the space. A year later, there's another commitment from a financial institution that says that's a good place to invest. The more that happens, the more the growth will naturally be propelled by the investor community.
And before that, the transactions were minimal.
That's right. They were strategic and minor.
So what about this month? Just earlier, I think Piers, you were there. We had this conference in London about I think it was called alternative investments. I think the word alternatives caught on.
At the beginning of February, yeah.
Yeah, exactly, right?
Hotel alternatives.
And there was a good presentation, which I think is available, and it's by this institution which measures yield, right? And basically the conclusion was in their data that they presented that hotels had performed in yield terms better than other asset classes in most markets in Europe over the last 10 years. So from an institutional point of view, the hotels, not just alternatives, everybody on the average hotels, but they of course segmented it between 5-star, 4-star, in apartments, etc. And some perform better than the others. But generally speaking, the budget end of the market performed better than the luxury end in most markets. And again, the budget stroke apartments and something which has more predictable yield and therefore has a larger volume. And I guess that's where we fit in as well, at different aspects of it. Certainly in our case, you're giving a yield in this as a return. And therefore, I think it's becoming more institutional. And therefore, we have this experience of having an institution like Fonse de Moor coming in saying, come on, we'd like to invest in you because we think that's a strong statement. And likewise, our competitors, Generator, they've got investment from Invesco recently, 20%. So our own segment, which call it what you like, is attracting investment because people realize that there's a yield generally in the hotel sector is good, but also within that, these players, ourselves and our competitors and yourselves, are performing even better than the hotel sector, the traditional
It's a good point sector. Because, if you look at what the poll says, your conference, the service department conference, Pierre, how many hotels have you now grown through with demand? Where are you up to now? Number 3, number 4?
What do you mean, sorry?
As in the number of attendees from the first to the projected?
Up to about 300 or so.
Right.
120.
Then you see another publication starting a conference that there's demand for that dialogue, which is extraordinarily
Which strikes me
important.
there's demand for focus. I think that's
Indeed.
the issue.
That's a great
There
point.
was not enough focus because that's what when you started.
And in terms of expansion, my own experience is that, of course, we've been looking at other markets. We're looking at the Americas. We're looking at Southeast Asia. I've just been to India, to Sri Lanka to look at what we can do there. The moment you discuss this with a developer, and developers are very smart. That's their game. They say, this will work. When can we do this? What's the deal? And the only thing, the risk appetite varies. In America, they may want a piece of the action upside, whereas in Germany, they want safety. And
what about the luxury market? Because that's a particular market, isn't it? From an investment point of view, and the barriers to getting into that. Because is it fair to say that institutions have some difficulties still with that? The pension funds of this world, on the whole.
Yeah, and they're looking for the safety that we may or may not be willing to give them under certain markets. We started our roots where we were owner-operators, and we split the company in two, and we moved to an asset-light model where we only operate. And that's one of the barriers to entry in so many markets, because we're constantly being asked to chip in, and we're open to that. But to answer your first question as to what are the barriers to entry, or what are the hindrances, it is more of a we've taken the approach of let's focus on one thing and do it right all the time. So it's making sure that we filter through all the opportunities for growth, and we only focus on the ones that support the growth of the brand in a uniform way that that we have communicated to our customers, and we continue to communicate in a uniform way. We have 16 open operating hotels. Some are 14 years old, and some are as recent as 2. And you can tell that there's a difference in product quality, design, aesthetics. We'd like to call our design timeless, but it's still you can tell things have moved. We call the Viceroy 2.0 and so on. And we're looking at how can we ensure that whatever we're adding 8 more properties in the next 3 years. How will these connect with what we have today, and what will the customer perception be of these new hotels? Because new design, technology is there, retrofit programs. How do we make sure that the first Viceroys still fit in the group? If not, do we call them something else? Do we position them as something else within the group, just to make sure that the integrity of the name is not diluted by virtue of our rapid growth? And we've taken a couple of tough decisions to walk away from opportunities, either because they didn't support the integrity of the brand, they would have caused more confusion to the customer and the guest than they would have contributed to us.
Okay, well, actually, we have officially run out of time. Does anybody have any burning questions that have to be answered now? No? Okay. Well, I think to respect the timing of the program, we should call it a day. Thank you very much for your attention. Thank you. Thank you. We're here all week.